Brian, thank you very much. And Dara, I'm thrilled that you could join us. Thanks for making the time.
Thank you for having me.
It was about 4 months ago. You sent this internal email to all of your employees talking about what you called a seismic market shift. You wanted to put a greater emphasis on profitability. What steps did you take back then that have put you in the position you are today? You were just on stage saying that you haven't really felt these recessionary impacts so far.
Well, I think it's important to know that even before I sent the memo, we had a real focus in terms of efficiency, cost, getting to profitability, getting to free cash flow profitability. And so the company was already tuned in the right way. We were much stricter about headcount growth. We were looking at marketing efficiency, where to pull back marketing efficiency, where to lean in it as well. And the business was really executing well. But what I saw was that even though we were executing well, the market was changing, and it was changing so fast, and good was no longer good enough. You had to do great in terms of both top-line growth and bottom-line growth. And for us, Uber, it's an incredible rally culture. I needed the company united, focused on driving profitability as well. We did just that. And what you're seeing now is, in the last quarter, we talked about 7% of gross bookings showing up in terms of EBITDA. We actually delivered 12%. So while our target was 7, we delivered 12%. And that was the theme, which is good enough isn't good enough in this marketplace. You know, interest rates are increasing, you're swimming upstream. You just have to go harder, and we're in a great position to do so.
And, you know, on Tech Check, we talk a lot about demand, right? And against this tougher economic backdrop, you guys are actually seeing demand continue, the momentum continues. What about on the inflation front, though? Consumers have sometimes noted that prices have become expensive, especially compared to pre-pandemic. Do you anticipate them ever getting to the level they were years ago, pre-pandemic, sort of how customers maybe knew Uber at the beginning?
So I think on the demand front, first of all, you're absolutely right, which is demand could be getting weaker. But for us, what we're seeing is we're seeing this secular shift from demand for retail, you know, Target, Walmart, some of the other retailers talked about some weakness, shift to demand for services. We're at a big conference now. Everyone's in person. The U.S. Open, you know, was record in terms of people going to that U.S. Open. So more and more people are going out, spending on services, going out in the real world, and that's been a real tailwind for us. In terms of inflation, you know, I think inflation, it's everywhere. So it's the price of a car, price of gas, thank God, is getting a little bit better, your groceries, et cetera. We're just a part of that basket in terms of spend. So we're not seeing spend move up or down. We're not seeing any signs of weaknesses one way or the other. If anything, 72% of drivers in the U.S. are saying that one of the considerations of their signing up to drive on Uber was actually inflation. Life is getting more expensive. They need to pay extra for their groceries. So on the supply side, we may be actually benefiting from the inflationary environment.
I want to dig into the financials a little bit because, as you said, you've always put the emphasis on profitability. We used to sit here and talk about adjusted EBITDA, and now we're talking free cash flow. You delivered positive free cash flow last quarter. However, when you look through the results, stock-based compensation was actually greater than free cash flow. Stock-based compensation, $470 million versus free cash flow of $382 million. Now, critics of this metric, like Dan Loeb and others, they argue that if you're not offsetting that stock-based compensation with share repurchases, you're actually destroying wealth. How would you respond to that?
So I think the first order bit for us is to have free cash flow that's higher than stock-based compensation. And I think that we're well on that course. Absolutely. Like 100% we're going to get there.